Another bank is on the brink of collapse. We talked about SVB a while ago, Silicon Valley Bank. Now we have First Republic Bank. Now, what's happening with these banks, to put it in simple terms, is they're over leveraging themselves. Now, a lot of these times, the banks are either leveraging extremely liberally or conservatively. When you have a situation where interest rates are rising, even if they're being conservative with their leveraging, so like they're purchasing bonds and things of that nature, and the interest rates rise, now they're underwater on those bonds. So if they have a bank run, like a ton of people go to the bank and they withdraw their money at a given time, that puts a lot of stress on the banks. And if they don't have those deposits, they don't have those reserves, and they're over leveraged and the interest rates go up, even if they're conservatively leveraging themselves, that's when there's a situation like a collapse. Now, to put this in perspective, for this specific situation, we have JP Morgan looking at First Republic Bank. Now, this is a major bank in the United States, but it's also in tandem with regional banks. So a lot of smaller banks, not just the big four banks. JP Morgan has decided, JP Morgan is the biggest bank out there, they have decided to take First Republic, and the government is facilitating the takeover with a $50 billion financing deal. Now, JP Morgan has the money, they have the AUM, the assets under management, they have all the assets they need to purchase this other asset, First Republic, on their own, but they're using the government because they're all cronies, right? The people in the federal government and the people at JP Morgan Chase, as well as other institutions in the banking industry, they're all cronies with each other, they're all friends with each other. So they give each other deals, they work off each other, there's mutual interest there. So JP Morgan can now use that $50 billion financing to take over a bank, and it doesn't put as much stress on JP Morgan in terms of coming up with those liquid assets immediately to have that takeover. Now, this is a forewarning and a foreshadowing because, well, to dive into this, we have a type of fascism here. Fascism, to put it simply on an objective neutral term, it's when corporations are working with government, typically in a negative fashion. And the negative fashion would be going after people's individual rights. In this case, it's consumer choice, because if you have a bunch of different banks and you have competition, that's great for the consumer. The consumer now has options between goods and services, and these firms in the marketplace have to compete with each other. So they have to have better products, better services, better quality, better speed. They have to be more efficient. They have to be able to compete with each other to win out the customer. When you have a situation where the government is coming in and they're not incentivizing competition in a situation like this, but they're actually removing competition and helping facilitate the consolidation of power and resources towards a major banking institution like JP Morgan Chase, the government is no longer doing its job of incentivizing competition. It's facilitating a fascistic takeover. So now, over time, we're seeing these regional banks collapse, but their assets don't diminish, they don't disappear, they go towards the bigger banks. So now these bigger banks are turning, they're already an oligopoly, but they're turning more into an oligopoly. So you have a monopoly, which is like one firm that has mass control over an industry, and then you have an oligopoly, which is few or many firms that have control over the industry. And typically these oligopolies work with each other on pricing so that they can all like, for example, you may have 3 gas stations on a street. If these 3 gas stations work together, they're the only business in that area, the only gasoline businesses in that area, they can work with each other and keep their prices relatively similar. Now, one of two options. One gas station might see another gas station lower the prices by 5 cents, and they might match that so that there's some competition, they can compete in that area. Or they might work together, like in an oligopoly, and all lower or increase their prices together if they realize they have leverage in that situation over the consumer. So in this case, the government is coming in. Hey, JP Morgan, we will help facilitate these assets towards you. We'll even give you a financing option using the taxpayer money, because the $50 billion that the government is giving JP Morgan Chase is not coming from thin air. It's coming from the taxpayers. That's how the government funds itself. So essentially, we, the taxpayers, are paying for a private institution to take over another financial institution. Completely fascistic. So when you have these corporations, these banking financial institutions, they absorb other financial institutions, and now there's an oligopoly. You have mass control over consumer choice. I'll give an example. I don't want to say any names, but if you go to a lot of the banks, a lot of them have brokerages tied into their products, right? So one of their products is an investment service. And you can create a brokerage account, and these might be these financial institutions are worth billions of dollars. Okay, they have the money to do this. They have the capital. They have the resources. They have the labor, the intelligence. They have everything that they need. But when you look at the user interface on the brokerage, it's terrible. I mean, it's very clunky. It's very hard to move around. It's not efficient. It's very hard to make trades. They can make that interface and the operation, the functionality of the interface for if anyone knows anything about brokerages, whether you're buying and selling stocks or you're trading options, they can make it much simpler. And there are smaller companies out there who have designed their user interface in such a way that it has galvanized people to come onto their platform. And a lot of these smaller companies are gaining more momentum because a lot of bigger companies are not catching up to speed. They realize they don't have to catch up to speed because they have so many customers. They have so much assets under management. People are voluntarily giving them money to the point where they see no need to innovate. They don't have to compete in that place because they're already ranked in the top 5 or top 10 of where people put their money in terms of investments or brokerages. So when you look at that and you see the consolidation of this situation, JP Morgan of First Republic, this now creates less consumer choice. Less consumer choice means it's a derivative of individual rights. So individual rights we're all consumers, right? To have the option to look at multiple companies and say, I want to, let me give a traditional example. There are 10 bakeries, and I'm going to use the old Constitution because I know now we have civil rights. But having civil rights, although I'm for it, technically it is unconstitutional because it removes the free market, the ability for people to operate in the free market, like from a totally infinite point of view. So if you have 10 bakeries and one of the bakeries says, hey, you're brown, we're not going to accept baking a cake for you. You have 9 other bakeries that you could go to. And if even 10% of those bakeries are smart enough to realize we don't care about race, color, or creed, we're going to take your business because we can make revenue off of that, we can profit off of that, then that's what competition is for. You have consumer choice. So if for some reason one business it doesn't want to serve you, or they don't have the good or product or service that you want, or it's not up to standard, you have other options. And other places are willing to compete and outcompete these people who are not matching up to the standard to win you over. When you have 1 bank, 2 banks, 3 banks, and they can all align with each other and do whatever they want, and their user interface sucks, they can give you 0.001% interest on your money. We're also seeing the rise of high interest accounts, high interest savings with online banks. These bigger banks, they realize they're commercial enough to take in the majority of the population's wealth, and they don't have to change their product or service. This also translates into another situation where the government can come in and say, hey, look, they'll say this to the average person. All of these banks are collapsing. These regional banks, if you're in Iowa, Texas, California, your local regional bank, which may seem relatively large to you in your local community, they're collapsing. And by the way, the federal government is bailing out depositors and potentially investors. So they're also using our taxpayer money to bail out banks. So they're privatizing profit for the banks, right? The banks, they make a profit. It's their profit. It's their company profit. It doesn't go to anyone else. But when they lose, when they fail, our taxpayer money is being used to socialize their losses. But the federal government can come in and say, look, all these local regional banks are failing. This is something we want to fix. And so we're going to create something like a Federal Reserve token, Federal Reserve currency. It's very similar to the US dollar. You guys are already operating in the digital world. It's going to be very similar. You don't really have to change anything, but we're going to remove the middleman. I'm saying this is, minimum 5-10 years in the future, because first they have to consolidate banks. Then they have to figure out a situation where the banks would still be useful, but get rid of the banks as a middleman. So the federal government through the Treasury and the Federal Reserve, and then you would have Congress interject there because Congress wants to spend money. That's where they can take advantage of this. Then once there's no middleman and the federal government can just put money in your bank account, hey, there's another lockdown, but don't worry, we're going to give you that $1,000 to $2,000 a month stimulus check, and it'll come immediately to your bank account, just like that. No prepaid debit card in the mail. You don't have to wait 6 weeks. It'll come in your account, and you don't have to worry. So they will present opportunity to you that is very easy. There's little friction, and the majority of people will say, yeah, that's the better idea because I don't want to put my money in a bank, and the bank collapses. I know it's FDIC insured up to $250K, but why do that when I can directly deal with the federal government, and they will give me my money on time, and I can use it how I want. Now, when you put that much power, when you give that much leverage to a centralized authority, where they're controlling your monetary wealth, the currency of how we do things economically, they can control how you invest, how you save, and how you spend. Now, they may say, well, okay, you want to spend your money, you can only spend X amount a month on gasoline and meat because the carbon output is something we're worried about, so we're limiting your purchasing power for those assets. And if you only have one direct way to get your money through the federal government, and it's, there's no middleman, there's no banks you can operate with, you have to align yourself with those measurements. And so they can also say, oh, you want to invest? Well, if you want to open a brokerage account, you have to have $1 million in net worth to be able to invest, because we think it's risky and only the people who have money to lose should invest. And you say, well, okay, but how can I make money? How can I make the $1 million if I can't even invest? Or they may say, oh, you want to open up a business, you have to have $1 million in net worth to open up a business, because we believe that's a risky thing to do. And if you want to be in the realm of business, you already need to have money that you could potentially lose. It's for your safety. That's why we're having this restriction, this regulation. And you say, well, okay, but how can I even make the $1 million if I can't start a business, if I can't invest? There's no way I can move up the ladder in the hierarchy. Now, a lot of people will say that makes sense. Businesses are risky, investments are risky, so of course they're looking out for me. But you're not even going to be able to make money if they bar you from those activities. So they can control your spending, saving, and investing. They can even say, hey, we know you have money left over for the month. We don't have the options for savings right now, so you have to spend the money within 2 weeks. If you don't, it expires, so you can't even save, right? So what this does is it eliminates the vast majority of people from competing with the people at the top. They'll have their own set of rules, but for the general population, the general public, they will determine how they want you to operate, because they don't want to be threatened with, now you can make millions of dollars and threaten their authority, right? When you have resources, you're able to facilitate strategy to move yourself up the ladder in the, not just government, but in the society that we live in. There's a hierarchy to it. So I say all that to say, you have the consolidation of banks, consolidation of assets. When you control the money, you control the people. You control consumer choice. You limit people's choices, right? So now the banks get to do whatever they want, and they're still profiting. Then you have the risk through, maybe it's by accident, and then the federal government is going to leverage the accident. Maybe it's orchestrated. Now you have a centralized token that will come out, very similar to the US dollar. And for your safety, this is why we're going to implement it. And then now you're restricted based off the parameters of the federal government on how you want to spend. And just to note this to everyone, yes, we do have Congress who is now spending trillions of dollars every single year on spending packages, and that's creating inflation, so our dollar is deteriorating. And the Federal Reserve gives the Congress money to be able to spend. But the vast majority of this inflation is coming from private financial institutions who can leverage something like 10 to 1. So when I say that there's a bank run, it means that there's not enough reserves in the bank to support the bank run. The bank run is people are going to the bank, hey, I want my 100 grand back. The bank faces too much demand, they don't have enough supply, they collapse, someone else has to buy them out to purchase the remainder of their assets, bonds and things like that. When you have a situation like that, it's only because of fractional reserve banking. So even though we've had all this induced regulation after the 2008 financial crisis, banks are still able to leverage 10 to 1, which means if they have 100K in deposits, they can fabricate money out of thin air, $1 million. So when you go out to get a loan at a bank, they're fabricating money 9 times out of 10. And that's why it's called fractional reserve banking, because they only need 10% of whatever assets they're fabricating. That's where the massive amount of inflation is from. Inflation, from an objective point of view, is just inflating the monetary system with more currency in circulation. That's why interest rates are rising right now, because when you increase interest rates, people don't want to borrow as much capital. In fact, they want to reduce their capital and throw it into savings accounts or bonds, less risky assets. They're going to be very conservative with their money, spend less, because money is more expensive to borrow. That reduces the demand, that reduces the money in circulation, and generally that's how you reduce inflation. Now, governments have it's not just the United States, governments have a bad habit of bloating the monetary system because they're thinking short term. The people at the top, they're all thinking short term. They don't really care about the next 100 years of America. They care about the next 10 years and how they can enrich themselves. So when you have a situation like, oh, well, I'll give you an analogy. A guy weighs 150 pounds. In a month, he gains 50 pounds. Okay, so he goes from 150 to 200. The next month, he loses 60 pounds. So he goes from 150, 200 to 140. Now, you can say over the past 2 months, that guy lost 10 pounds. That sounds pretty good. Not realizing the details are he's bloating himself up and then he's shrinking down drastically. That's not healthy for his organs and for his body. Even your skin elasticity gets screwed up with that. Now, the federal government is doing that, but at a huge scale. So they're bloating the entire monetary policy up, and then they're shrinking it down. But they're not even shrinking it down. Like in the example I gave, he actually lost 10 pounds. Every time they shrink it down, we're still inflating our dollar. So if you compare the dollar right now, 2023, to 100 years ago, 1923, it still has inflated a bunch, right? I think on average it's inflated 3 to 5% a year, something like that, very close to that number. Some years it's inflated 10%, some years it might even be disinflation, deflation, although that's not very often. Now, we do need inflation 1 to 2% to have a currency so that the pie, because generally we want to have more people and create more opportunity for people. So you have to have a slightly inflationary currency so that you grow the pie, right? You can't have a zero-sum game. Like Bitcoin is a zero-sum game. There's only 21 million Bitcoin. You can't really use that as currency because after a period of time, there's not much more of the pie that people in 100 years could use. I'm using 100 years as an example. It might actually be 500 years. You have to have that 1 to 2% inflation. The problem is people will always be able to manipulate the monetary policy for their short-term interest. And so they may inflate it for 5 years, and then they realize, oh, we screwed up. We have to deflate it so we can get back on track, and our money can actually be worth something, because even the people at the top, they can handle a 10 to 20% inflation rate. They can't handle a 50, 60% inflation rate, because then their dollar, even though they're multimillionaires, their dollar is degrading at such a rate that even they themselves, as an elitist class, cannot deal with it. So I say all that to say, this is a foreshadowing of banks, assets, all consolidating power, the federal government working with banks, and the potential for a centralized currency to come in, only to disguise itself as a way to control us, the population, as a labor and resource force, so that the centralized power gets more authority, thus creating a barrier between us and the people at the top.